Hello and welcome back to my morning report analysis videos on Tuesday 22nd of January with me, Richard Perry, market analyst at Hantec Markets, looking at dollar yen, which has interestingly started to slip back a bit. It's still in an uptrend, and I can show you that on the hourly chart, this little uptrend over the past week or so, this recovery that we've had. However, yesterday's candle was a shade negative, and that's continued into today's move, this risk-off move that we've got through markets, through financial markets today. Now, it's interesting that this resistance came in at 109.90, basically just between 109.75, 110 figure, which is the old sort of resistance band of these old key lows. So the fact that we've seen that high coming in there leads me to question that if you start to break this uptrend, and certainly if you break back below 109.10, there is the prospect of this recovery now starting to gather momentum back to the downside again and falling over. You've got the RSI failing at 50 or under 50, which is an interesting point again. However, despite that, you do have the stochastics which are still rising and the MACD lines which are still rising. So the prospect of this still being a recovery intact is still there. However, it's a testing time for this recovery. You've got the uptrend on the hourly chart, which is now being tested as we speak. Momentum indicators have just taken a little bit of a dip back as well. Throughout that recovery uptrend, you saw the RSI time and time again bouncing off sort of mid-40s and rallying. That's now been broken. MACD lines time and time again bouncing above neutral, but now just gone below neutral. So there is a question mark surrounding this rally, but 109.10 being that near-term breakout, I think is a key level of support, and if that gets broken, you're looking far more corrective again. So this is an interesting turning point potentially for dollar yen, but one to keep an eye on. So I wish you good luck in your trading today, and I'll speak to you later.